September 2022. Federal courthouse in Fort Worth, Texas. A jury returns guilty verdicts against 2 executives. Wire fraud, securities fraud. Money laundering, the scheme. $150 million. According to DOJ filings, they sold investments in oil wells across West Texas. Hundreds of wells. Dozens of drilling sites. Maps showing productive formations. Engineering reports promising returns of 15 to 20% annually. Investors bought in. Retirement accounts. Family trusts. Small investment funds. The wells existed. The drilling rigs were real. The land leases were legitimate. But according to federal prosecutors, the oil wasn't there, and the money gone. This is the story of how 2 men turned empty drilling holes into one of the largest investment frauds in Texas history, and why it took prosecutors 7 years to catch them. West Texas, the Permian Basin, one of the most productive oil fields in the world. Billions of barrels extracted over the past century. Companies like Exxon, Chevron, pioneer natural resources. They've been drilling here for decades, and where there's oil, there are investors looking for a piece of the action. Enter James Frederick Calhoun and Joseph Brian Blimline. According to SEC records, Calhoun had worked in the oil industry since the 1980s. Roughneck driller, eventually small-time operator. He knew the business, knew the terminology, knew how to talk to investors. Blimline handled the money side. According to court testimony, he managed investor relations, paperwork, financial statements, communication. Together, they ran a company called Montierra Minerals and Exploration. The pitch was simple. Invest in Texas oil wells. Small stakes, $5,000, $10,000, $25,000. Get a direct ownership interest in producing wells. Receive monthly royalty checks based on production. It's called a working interest investment. According to oil industry practice, investors own a percentage of the well. They share in profits. They also share in costs, drilling, maintenance, operations. But Calhoun and Blimline promised something better. No operating costs passed to investors. Fixed returns 15 to 20% annually. Backed by actual oil production. According to marketing materials presented as evidence at trial, they claimed their wells were in proven formations, sweet spots, high productivity zones. They had maps, geological surveys, production forecasts from engineers. Everything looked legitimate. The first investors came in around 2013. According to SEC filings, Montierra raised approximately $3 million that first year. The pitch worked because it solved a psychological problem. Oil investing is risky. Everyone knows that. Dry holes, failed wells, market volatility. But Calhoun and Blimline offered proof. They showed investors actual wells, physical sites, drilling rigs in operation, pumps extracting oil. According to testimony from investors who visited the sites, they saw activity. Workers, equipment, oil storage tanks. It looked real, 'cause parts of it were. Here's how the fraud worked. Montierra did drill wells. They did lease land. They did have equipment. But according to federal prosecutors, most of the wells produced little to no oil. The geology was wrong. The formations were depleted. The drilling targets were deliberately chosen for their poor prospects. Why would they drill bad wells? Because they needed the appearance of legitimacy. Investors could visit, see the rigs, watch the operations, feel confident their money was working. But the wells generated almost no revenue. So where did the investor returns come from? New investor money. Classic Ponzi structure. According to DOJ filings, Calhoun and Blimline used approximately 80% of new investments to pay returns to earlier investors. The rest went to personal expenses, homes, vehicles, travel. The scheme scaled quickly. By 2015, according to court records, Montierra had raised over $40 million from more than 300 investors. The company expanded operations, more wells, more sites. more promotions. They hired salespeople, paid commissions, built a network of brokers and financial advisors who marketed Montierra investments to their clients. According to testimony from one broker, Calhoun seemed credible. He spoke the language of oil, knew the technical details, had been in the business for 30 years. The financial statements looked professional, audited by a small accounting firm in Texas. Balance sheets showing assets, wells, equipment, land leases. Everything appeared legitimate. But according to forensic accountants who later analyzed the records, the financial statements were fiction. Assets were inflated. Well values were overstated by factors of 10 or more. Production estimates had no basis in actual geology. The accounting firm, according to court findings, they relied entirely on information provided by Calhoun and Blimline. No independent verification, no site visits, no production audits. By 2017, cracks started showing. Oil prices had dropped significantly in 2014 and 2015. The industry faced pressure. Real operators cut costs, reduced drilling, focused on their best wells. Montierra should have done the same. Instead, according to SEC filings, they kept drilling, kept raising money, kept promising returns. Some investors started asking questions. Why were returns so consistent when oil prices fluctuated? Why didn't production reports match the promised output? Why were there so many new wells being drilled if existing wells were so productive? According to court testimony, Calhoun had answers for everything. Production was hedged. They'd locked in prices through futures contracts. Reports were delayed because of state regulatory filing backlogs. New wells were being drilled in even better formations. Higher productivity, better returns. Most investors accepted the explanations, but a few didn't. One investor, a retired petroleum engineer, visited several well sites unannounced. According to his testimony at trial, he found wells that weren't producing, equipment that wasn't running, storage tanks that were empty. He reported his findings to Montierra. According to court records, Calhoun told him those particular wells were temporarily offline for maintenance. Normal operations, nothing to worry about. The engineer wasn't satisfied. He demanded detailed production records, monthly output data, state regulatory filings. Calhoun provided documents, but according to forensic analysis, the documents were fabricated. Production numbers didn't match Texas Railroad Commission records, while identification numbers didn't correspond to actual permitted wells. The engineer filed a complaint with the SEC in early 2018. The SEC began investigating. According to agency records, they requested documents from Montierra, bank statements, investment agreements, production records, geological surveys. Calhoun and Blimline cooperated, provided documents, answered questions. But according to SEC investigators, the responses were incomplete. Documents were missing. Explanations were vague. The agency dug deeper. They contacted the Texas Railroad Commission, the state agency that regulates oil and gas operations. According to Railroad Commission data, many of Montierra's claimed wells either didn't exist or showed minimal production. Wells that Montierra reported as producing 50 barrels per day were actually producing 2 or 3. The SEC obtained bank records through subpoena. According to financial analysis, money flowed in from investors. Small amounts went to actual drilling operations. The rest was distributed as investor returns or personal expenses. Classic Ponzi mathematics. In June 2018, the SEC filed a civil complaint in federal court. According to the complaint, Montierra and its principals had defrauded investors of approximately $150 million over 5 years. The agency obtained an emergency asset freeze. Montierra's bank accounts were locked. Operations ceased immediately. Investors received notice. According to court-appointed receiver reports, the situation was worse than anyone realized. Montierra claimed to own interests in over 400 wells across West Texas. The receiver's team visited the sites. according to their findings. Most wells were unproductive or non-existent. Some well locations were vacant land, no equipment, no drilling, nothing. Of the wells that did exist, many were barely producing. A few barrels per week, not enough to cover operating costs. Let alone generate investor returns, the total legitimate asset value. According to bankruptcy filings, approximately $12 million. Investors were owed $150 million. The shortfall, $138 million. Gone. Where did the money go? According to DOJ financial analysis, approximately $40 million went to earlier investors as fake returns. Another $60 million funded continued operations. Drilling unproductive wells, maintaining the illusion, and the rest. Personal use. Court records showed Calhoun purchased multiple properties, luxury vehicles, a private plane, vacations. According to bank records, he spent over $8 million on personal expenses during the scheme's peak years. Blimline was more conservative but still spent millions. Real estate, vehicles, country club memberships. Both men maintained the appearance of successful oil executives. The criminal case moved forward. In November 2019, a federal grand jury indicted Calhoun and Blimline on multiple counts: wire fraud, securities fraud, money laundering, conspiracy. The trial began in September 2022. According to courtroom observers, the prosecution's case was overwhelming. Financial experts testified about the Ponzi structure. Geologists explained why the wells couldn't produce as claimed. Investors described their losses. Former employees testified that Calhoun and Blimline knew the wells were unproductive. According to one driller's testimony, Calhoun once said, "It doesn't matter if there's oil, it matters if investors think there's oil." The defense argued Calhoun and Blimline were victims of market conditions. Oil prices collapsed, good wells went bad. They made business mistakes, not criminal choices. The jury deliberated for 2 days, guilty on all counts. In December 2022, Calhoun was sentenced to 15 years in federal prison. Blimline received 12 years. Both were ordered to pay full restitution, $150 million. According to federal prosecutors, they'll never pay it. The money is gone. So how did this happen? How did two men run a $150 million fraud for 5 years before getting caught? First, complexity. Oil investing is technical. Geological terms, engineering data, production metrics, Most investors don't understand the details. They rely on experts. When the experts are the fraudsters, verification becomes nearly impossible. Second, physical props. The wells existed. The land was real. The equipment was visible. This wasn't a paper scheme. Investors could touch the assets. That tangibility created false confidence. Third, small early returns. According to investor testimony, initial returns were paid reliably, 5%, 8%, exactly as promised. This established trust. By the time investors considered expanding their stakes, the trap was already set. Fourth, social proof. According to court records, Calhoun actively encouraged investors to bring friends and family. He offered referral bonuses. When people saw their neighbors investing and receiving returns, skepticism diminished. Fifth, regulatory gaps. The oil and gas industry has different oversight than traditional securities. According to legal experts, certain oil and gas investments can be sold without full SEC registration if structured correctly. This created confusion about which agency had jurisdiction. Sixth, geographic isolation. West Texas is remote. Wells are spread across hundreds of miles of rural land. Casual verification is difficult, according to testimony. Most investors never visited more than 1 or 2 sites. They couldn't see the full scope, or lack thereof. The Montierra case is not unique. According to SEC enforcement data, oil and gas investment fraud has generated billions in losses over the past decade. In 2019, a Colorado scheme defrauded investors of $90 million through fake drilling partnerships. In 2020, a Louisiana operation was charged with stealing $47 million through inflated well valuations. In 2021, North Dakota fraud cost investors $32 million in non-existent mineral rights. The pattern repeats: complex industry, physical assets, trusted operators, and stolen money. What should investors watch for? First, guaranteed returns. According to industry standards, oil investing is inherently volatile. Anyone promising consistent double-digit returns regardless of oil prices is lying. Second, pressure tactics. Legitimate operators don't need to rush you. According to investor advocates, any investment requiring immediate decisions should trigger skepticism. Third, limited documentation. According to oil industry attorneys, legitimate operators provide detailed production reports, state regulatory filings, independent engineering assessments. If an operator resists providing these, walk away. Fourth, unverified financial statements. According to accounting standards, small firm audits are not equivalent to major firm reviews. If the auditor is a local CPA with no oil and gas expertise, the audit may be worthless. Fifth, referral incentives. According to SEC guidance, legitimate investments don't pay bonuses for recruiting new investors. That's a Ponzi indicator. Sixth, complexity without clarity. According to financial advisors, if you can't explain the investment in simple terms after reviewing the materials, you don't understand it well enough to invest. James Calhoun and Joseph Blimline are in federal prison. The wells they drilled sit abandoned across West Texas. Unproductive, unprofitable, monuments to fraud. $150 million stolen from 300 investors. Retirement accounts, depleted. Family trusts, destroyed. Financial futures, shattered. According to receiver reports, investors will recover approximately 8 cents on the dollar. Maybe the rest is gone. The empty rigs stand as reminders. Not all that looks real, is real. Not all that's tangible, has value. And not all who speak the language of legitimacy, deserve trust. Numbers don't lie, but people do. This is Torven Report. We investigate financial fraud. We expose white-collar crime. We follow the money so you can protect yours. The next fraud is already running. The next scheme is already recruiting. The next Calhoun and Blimline already drilling their empty wells. If you want to stay ahead of the scams, if you value investigations that go deeper than headlines, if you believe knowledge is your best financial protection, subscribe to this channel, because the fraudsters are counting on you not knowing. We're here to make sure you do.